Welcome everybody. My name is Larry Kane. I'm a partner at the law firm of Orrick, Harrington, Sutcliffe. Thank you to MARL, Amir and Prakash for setting this up. We're going to dive deep into the anatomy of a venture capital term sheet, what all these terms actually mean. Why should I care if I'm an entrepreneur or an investor? We'll talk about market conditions. And as I said, I like to usually do this conversational if possible. And so, please feel free to use your chat button if you want to ask questions as we go on. Amir, want to go to the next slide? Next one. And next one, this gives you a little bit about Orrick's practice. It's international, it's highly focused on tech. We represent 2,700 venture-backed companies. Every week we're doing many financing, seed financings to Series A's to later stage rounds. Next slide. So the goal today is to talk about sort of not seed financing, but institutional venture capital financings and what those term sheets like. And the framework of my conversation today will be of an entrepreneur who has not raised financing and is looking for their Series A. And obviously later rounds have different issues and different forms, and seed financings are different. So the construct here is you may have already raised a seed round, things are going well, and you're looking to raise venture. And what I want you to be prepared for is, what does that term sheet look like? What are the issues there? What should I be looking for? And how do I evaluate it? And to start off with, I just want to mention the NVCA form. So NVCA stands for the National Venture Capital Association, and they have standardized venture capital documents, and they have a very detailed term sheet. And generally, that's used throughout the country. It's fairly market. It is, generally more investor favored. I like that form a lot, especially when I'm representing investors, because it reduces the negotiations and issues. All the law firms, including Orrick, all the big law firms, I should say, have our own forms. And the Orrick form is an excellent form. It's integrated. We keep it up to date. We spend a lot of money and time on our form. It is definitely more founder favorable. And if we're working with, the other, Bay Area, Silicon Valley firms, they'll know our forms, we'll know their forms. And it's one that we can evaluate, if we see a Wilson form or a Fenwick form, and vice versa. But often we're working with law firms who are not familiar with our forms. And the NVCA form, really covers all the issues, and it's very detailed, and it's pretty quick and easy to look at issues and decide, why did they change that piece of the form, and it's one you can have a quicker discussion with. So even though the NVCA form is very lengthy and has lots of details, I do think in the long run, it's actually a lot more efficient on getting these transactions done. I will point out, even though we're talking institutional venture rounds, there is another form out there, the Series C term sheets, which we talked about last week. There has been a growth in the size of those rounds, and I am seeing those rounds, grow to 2, 3, even higher millions of dollars. And so even yesterday, I was in a discussion with a potential, an entrepreneur with a potential investor, and they're truly, in a seed stage. They don't have any revenue or business yet. And so we started off with the Series C term sheet, even though the financing number was significantly higher than what we think of it, just given their stage of their company. Okay, so next slide. So before we get actually into the legal terms of the term sheet, meaning like, what are the terms of the deal, there are some, basic standard provisions that an institutional term sheet usually will have. And so you should expect this. If you're going to get a term sheet from Sequoia or anybody, institutional investor, these, usually you're going to see the term sheet is confidential. There's going to be what we call an exclusivity or no shop provision. You should be expecting that they may be asking that, you're going to, the issuer, cover their legal fees and expenses. And as I said, one reason I like the NVCA form is it's lengthy and detailed. I think that actually favors the entrepreneur. When we see fairly short term sheets that say everything's going to be market and what's customary, that leaves a lot of vagueness in the details. And even though the term sheets are non-binding, we'll be going, when we do the deal, when you're working on the actual documentation, we'll be always going back to what the term sheet says. And the lengthy, detailed term sheet, I think, really helps the entrepreneur because it really specifies what the rights are of the investor and doesn't leave it to what's market, because market, there can be a wide range of what market is on almost every term. On the exclusivity and no shop provision, just a small comment on that. I often get situations where a client will get a term sheet. It'll have a confidentiality and an exclusivity, but they're waiting for 2 or 3 other term sheets, or they want to tell another investor, well, I got a term sheet from X and it's got this valuation. That there's issues with that, and you'll have to work with your lawyer on how to manage that situation. The one question that I get a fair amount is, well, it's non-binding. How really enforceable is this exclusivity provision? And there are cases out there where entrepreneurs and companies who've signed a binding term sheet or non-binding term sheet, but these provisions are binding, could get sued. And so I recommend and advise any entrepreneur to follow those terms where they are going to be probably enforceable, and that there are risks if you don't follow them. So the idea that you're going to be able to negotiate often these term sheets is difficult. Okay, next slide. Okay, so just as a framework today, we only have about 40 minutes here. I don't think we'll probably get through the entire presentation. And so, Amir, what I'll do is go at a reasonable pace. Again, people should be asking questions as we go through it. And if we don't finish, we don't finish, and maybe we'll do another session to continue the presentation versus racing through things. Because some of this stuff, I think, if you're looking at this for the very first time, maybe like, what's he talking about? Why does this matter? And so I'd rather nail these things than race through them. But in general, the venture capital term sheet should address 3 areas of concern for entrepreneurs and investors. And remember, at the highest level here, it's going to be a partnership. You enter into a partnership where the entrepreneur is providing the vision, the sweat equity, the team, the vision, everything to execute. And usually the investors are bringing, the cash and liquidity for you to execute, as well as, many VC investors will have additional domain expertise that will assist, entrepreneur. I would say to you that when you evaluating term sheets, it's not always the actual valuation and the terms that are the most important. I will tell you, to me, the most important is finding a true partner, somebody who you have as somebody you can go to if an entrepreneur that will be there when things get difficult. Because the path of startups aren't always straight. They're left, they're right. You may have twists, turns, things go up and down. And there's going to be times you're going to need to call on your board and your investors to either dig deep and write another check or maybe make an introduction. And so we're going to get into the nuts and bolts of the legal provisions of it. But I've had many clients over the years choose a term sheet that on its face looked worse, lower valuation, more rights for the preferred or the investor, but the synergy between the VC and the founder was just much better, or there were some other strategic benefits that made the intangibles more important. And when I advise clients, the first thing I always talk to them about, when you're evaluating two different term sheets, who would you like to work with? Who are you going to be in? Because you're going to be in quarterly board meetings for a very long time with this person, and is it somebody that you can get along with and have discussions with? And so I wanted to point that out as we get into it. But when we get into the detail of the term sheet, there's three general areas that they cover. What is the value of their investment in the company? Who controls the company? Management of the company going forward. And what happens on liquidity, or how can the VC gets money in? And remember, at the highest level, the investor is coming in as a minority shareholder, meaning that the founders generally will have control of the business. They'll have a control of the board. This is on the Series A. They'll generally run the day-to-day affairs of the business. And anytime you have a minority investor coming in, they're worried that the majority will go amok and spend all the money unwisely, or make bad decisions, or do something that would not make sense for them. And so the term sheet and the terms of the deal are designed to protect them because they don't have the majority. And under Delaware law, generally under Delaware corporate law, the majority rules. The majority of the shareholders get to elect the majority of the directors. In fact, all the directors under Delaware law, voting agreement, or choose cumulative voting, which is rare under Delaware law. And the directors get to pick the officers, and they get to, subject to fiduciary duties concerns, basically run the day-to-day affairs of the company. So a lot of this is dealing with that new partnership, that new relationship. And so these are the general purposes when you look at these term sheets. Okay, next slide. Just to make sure we understand the type of security that these term sheets cover. And it's something called convertible preferred stock. And people may not understand what that means. So what it means is basically the VC or the investor will purchase capital stock called preferred that will convert into common stock upon certain events. And so if you think about it, the preferred, when you've got this right, is going to have all these rights: liquidation preferences, dividend protections, preferences, redemption rights, protective rights. Those all exist as long as it's preferred. But eventually, the goal is that it's going to convert to common, and usually that's on IPO. And the conversion ratio is initially 1-for-1. And at that time, all those rights go away. And if I had a graph behind me, I would say to you that the ideal here is when you first create the company and you've got common stock and preferred stock, the preferred stock is going to have a higher value than the common stock on day one because it's got all these rights that we're going to talk about. But as the company goes on in its growth and it continues to grow and continues to get closer to an exit, the value of the common and the preferred hopefully will converge and actually match. And an IPO, they match and they're exactly the same value. So that's the traditional trajectory. And we'll talk about more about these other rights, but generally it's convertible preferred stock. So the preferred stock has these rights on day one, but hopefully by the time you go public or liquidity event, it'll basically be treated just like common stock. Okay. Somebody just asked a question. Isn't it cleaner and more motivating if everyone is common stock? Well, founders often think, and obviously you would say everybody's aligned with that. That is not market. And there's two issues for that. One is, there's another slide a little bit about this, is the preferred investors want to make sure that they get money out first if there's a downside. The entrepreneurs are doing sweat equity. They're getting maybe paid a salary. But if there's going to be an exit, the investors are going to want to get their money out first. There's actually a benefit to the entrepreneur here. And that, let me go to the next slide. We'll have another slide covering this, but just to finish that point, is generally entrepreneur wants to be able to attract and motivate employees. And because the common stock initially has a lower value, and there's something called a 409A valuation that's required when you grant out equity incentive to employees and consultants and advisors, there's generally a fairly high discount early on in the common stock value. So if you've done a preferred stock financing and you've got a $10 million post-money valuation, the common stock value may be 25% of that, could even be lower based on these 409A valuations. That'll allow you to attract employees, giving them options based upon that lower valuation. And that'll allow you to attract those people without having them come at the higher valuation. The wish of everybody getting common stock for investor is one, not market. Two, investors are going to not want to do that because they want to protect themselves in the downside. And three, it's going to make any employee grant be priced at that higher valuation. So it'll make it harder for you to attract employees and management. So talking about probably the most important term to a lot of entrepreneurs is what's the valuation of the financing. And as Prakash and Amir can tell you, is valuing startups is not a science. It is completely an art. When you're evaluating real estate or licensing, you can look at your projected cash flows, take a discount of it, and take a current present value of that value, and that's going to be your valuation. Most startups aren't valued based upon that. I mean, that's one basis to look at your pro forma projections, but the investors who I work with, they don't always look at those projections as real. I mean, there's so many assumptions in there. So it is often you're looking at other comparable startups in the space, what they're getting. They'll look at your team and your experience. They'll look at a whole number of factors. But the actual valuation is much more of an art. I will tell you, with COVID-19, this is highly stressed right now. We are seeing, deals that were that we had term sheets prior to COVID-19 getting done. We're not seeing a lot of new term sheets right now, and we're seeing investors do a lot more convertibles because trying to price it is very difficult. And I'm not sure if Amir, Prakash, you're seeing anything different on that, but it's definitely difficult on the valuation.
At this point, Larry, to tune in here. So absolutely, there's the deals that has been started before the COVID, the term sheet issue. Those are the ones being closed right now. The DD is kind of hard at this point because there's so much going on. There's so much volatility in the market. I think it will definitely the relationship has been formed. I'm not sure why exactly. The relationship has been formed right now. I mean, I would highly suggest if you think that certain VCs are right fit for you, go talk to them, start the relationship with them, have a conversation, get the feedback. But no one's issuing a term sheet at this point until there's more clarity in the market.
We actually have, I'm not sure if Kate O'Loughlin's on, we have a list of supposedly open and active VCs. And we could share that with you that are supposedly issuing new term sheets. But I think generally it's a difficult market. We're seeing a lot of follow-on rounds from existing investors re-upping, those types of deals. So when we do look at a valuation, I just wanted to make sure people understand about what's in the denominator here. So if somebody says to you, we're going to give you a $7 million pre-money valuation and we're going to put in $3 million, so we get a $10 million post, that investor is thinking, I put in 3, post is 10, I need to own 30% of the company. And they're going to want to put into all other stakeholders in the company their share. So that's going to include all the founder stock, even if it's unvested. I get questions sometimes, well, what about unvested stock? All of that counts. They'll include the employee stock pool completely, so the entire pool, not just what's granted. That can be a negotiation, whether some of it's pre or post, but generally you should assume that it's going to be pre-money. And then all your notes, you've done kisses, safes, all your convertibles would also be typically in the pre-money valuation. And again, some investors founders will try to negotiate that last point. And if your last convertible was, just, a few weeks before the round and really hasn't been spent and that money's still in the company, there may be an argument that could be post money. But I think going into it, you need to assume that all your existing stock is going to be pre-money, and the new investor, in my example, will push that all onto the basic dilution to the founders. Okay, next slide. So just as an example, as I'm trying to spell out, is if you've got a $7 million pre-money valuation, $3 million of new money, $10 million post, the new investors are going to get 30%. You're going to see, typically an option pool anywhere between 10 and 20%, and that number can be negotiated, and it should be the size of the pool should basically equal the size you need to make grants over the next 12 to 18 months, until the next financing. The investors are going to want a reasonably sized option pool. If you go out to to an investor and say, I only need a 5% pool, you better have already granted your major team, all the equity they need. If you've got, basically your team done, you're not going to do a lot of grants, you can negotiate that number down. But in general, we often see about 20%, 10 to 20%. It's fairly typical. Obviously, in my example, the convertibles, the safes and notes, convertible notes, have 5%, but they could have more. It just depends how much you've raised. And so you can easily see that after your Series A, the founders could even be below a majority. And so just wanted to highlight that out. Now, obviously, this is all negotiable. Go ahead.
Larry, there is a question about the exclusivity when there are multiple investors on the same round. Can you touch base? There is a question on the chat room.
Okay, yeah. So there was a comment about exclusivity on the previous slide. How does that work when there is more than one investor in the round? So often, what happens, we'll have what we call a lead investor, and they'll form a syndicate. So you can have a lead investor is going to do, basically the whole round. I think that's still happens, but often we'll see a syndicate. And generally, you'll work, the term sheets will have a provision that if you sign the term sheet, they've got the deal, it's binding, and then you're going to form the syndicate, and the investor will help you form the syndicate. And you'll work with them to get that done. What I don't want you to be doing is forming a rival syndicate, like two different term sheets. You're not going to want to do that. Well, the slide, you guys can get the slides. I know that'd be great. No problem. Okay. So, again, the main purpose of this pro-forma example is that I think it's really important for any entrepreneur to really have a good understanding of their cap table, be prepared to put together a pro forma cap table pre and post offering, and really understand the economics of what's going on. And your counsel should be able to help you with that. And so understand how the valuations and dilution works is really critical. Next slide. Okay, so as I mentioned, the first set of terms in the term sheet relate to valuation. And there's a number of terms in the term sheet that affect the valuation of the investment. So in the pro forma example I gave to you, the VC owns 30% of the company. So you would think that, if you sold the company for $10 million, they're going to get 30% of that, roughly, $3 million, in a liquidation preference, a liquidation scenario, sale scenario. However, there are terms in the term sheet that will affect return. Go through a number of those and how it works and understand how it works. So the basic definition of a liquidation preference is that the preferred stock will have a right generally to get their money back before the common stock. And so if we sold the company exactly for $10 million, if they have a standard liquidation preference, they will get exactly $3 million back, or 30%. But if you sold the company for $5 million, they would still get $3 million back, which is much higher than 30%. And so that's how the liquidation preference works. It protects the investors on the down scenario, the scenario where you sell the company or have an exit below the post-money valuation. Now, there are certain things within liquidation preference that can alter that formula. So some liquidation preferences say, well, it's not just my money back. I want to have accrued and unpaid dividends. We'll talk about dividends in a moment, but some investors want to have a guaranteed return on their money. They may have in their own partnership agreements a guaranteed return to their LPs, and so we'll see that often when we get to dividends, with a cumulative dividend. So the liquidation preference may be not just the cash invested, it may be cash plus dividends. So if there's a 8% or 10% dividend, it's been 3 years, that's grown from 3 million to 3.3 million. That'll come first. Now there's two other terms that you see sometimes. Something's called participating preferred and participating preferred with a cap. And these are the things that you need to be careful and to watch for. So currently in the current market, participating preferred is really not market. We rarely see that today. If we do see it, we do see it with a cap. I'll explain the difference. So with a participating preferred, the preferred gets their money back and then participates with their percentage of the company and what's left over. So if you had a $10 million exit, they should just get $3 million or 30% if it's a normal liquidation preference. But if it's participating preferred, they would get first their $3 million back. That leaves $7 million left. Then they'd get 30% over $7 million. So roughly another, $2 million, whatever that is. So their total return in that scenario is roughly, $5 million, which is much higher than the 30%. So entrepreneurs need to be on a lookout when they're evaluating these term sheets for something called participating preferred. Now, often when the markets change, right now in the past history, recent history, pretty much we didn't see any participating preferred. But when we start turning into what I say a buyer's market, where the leverage is turning to the investors because term sheets are hard to get and it's hard to raise money, we may see more participating preferred. And generally what we'll want to see if you're negotiating these, some type of cap on the participation, 1.5. If it's usually above 2 or 3, that's really, really high. I have seen deals up to 4, but those are fairly distressed deals. But, so if you do see a participating preferred, we will want to put a reasonable cap on that. Okay. And on cap participating preferred, we do see, again, on distressed situations when there's really no choice. I often advise, investors to be wary of these terms, because if you've got it in your term sheet on a series, it is most likely going to continue on for the series B and C and D. And that may not be in the series A investor's best interest to have those types of terms continue. Next slide. Okay. I mentioned this in the previous slide. So again, you don't often see something called cumulative dividends. The most common and what's most market is something called dividends that are payable as and when dividends are declared by the board and payable on the common, which means in startups, never. Startups rarely ever declare a dividend. Even big tech companies don't often declare dividends, even after they're public. So we generally like to look, when and if declared by the board, which means they're not payable. So what's standard and what's market are non-cumulative dividends, payable only when and if declared by the board. And even if you've got a rate of 8% in there, those will be paid. However, if a term sheet has something called cumulative dividends that are mandatorily paid, usually maybe on a conversion, on redemption, or on some other liquidity event, those are payable and they'll become a preference over the common. And one thing to note, I'm not an accountant, but if you've got cumulative dividends and a redemption rate of redemption within 5 years, there's a risk that the preferred may be treated as debt on your books and records, which is not always the best. Next. Okay. Anti-dilution protections. So we're talking about a valuation of the company, again, $7 million pre, $3 million, $10 million post, and they've got 30% of the company. The way normally anti-dilution works is if you do future financings above that price per share, there's no adjustment. And this is something that I have to tell people, that they're not, an investor that's got anti-dilution protections, it doesn't guarantee them 30% of the company forever. My example, it just guarantees that their value of their investment basically remains the same. And if you do a new financing and the price of that financing is at the same price or higher, it's not going to trigger any of these anti-dilution protections because ideally their shares are going to be worth more at the higher price. They got the same number of shares, higher price, the value of the shares should be equal or higher. No anti-dilution protection. So it's not a protection on their percentage, but more on their value. I just want to make sure that when people talk anti-dilution, they get so focused on the numbers of shares and the percentage of shares they own versus the value of the shares. Okay, so it's the value of the shares. If they go down on a financing because the new financing is priced lower, then they can get anti-dilution protection. Generally, there are 3 types of anti-dilution protections. And if you're, again, an entrepreneur looking at this, the one that you want to look for is something called broad weighted average anti-dilution. Broad weighted average anti-dilution. I'm not going to get into the formula and how it works, but to compare it to ratchet, I'll give you a basic example. Ratchet anti-dilution means whatever the price is of the new round, you've adjusted your conversion price to that price. So basically, you reprice the new round. So in the example I had where you put in $3 million on the 7 million pre and 10 million post, and just say there was 700,000 shares outstanding at the time, or 7 million shares outstanding at the time, you'd have $1 per share in your price. If you did the next round, and for whatever reason, the price was 50 cents, you would be repricing the conversion ratio, so all the preferred stock would convert into common at 50 cents. So basically, double their shares. That's ratchet. Now, the way broad weighted average anti-dilution works is you would have a weight of that adjustment based upon how much you raise. So if the new round, say it was a series A1, and you only raised $500,000, and you had $10 million or 10 million shares outstanding, you would basically adjust the conversion ratio a minor bit because it's not that much money being raised, and there's so many shares outstanding. It's not a real big factor in the dilution. And so the broad weighted average anti-dilution mitigates the impact of a new or lower price deal based upon how much raised and how many shares being raised at lower prices to the total outstanding. Now, I went over that pretty quick, but it's hard to get into details with this with such a short time. Now, there is one other type of anti-dilution we should mention, and these are called special adjustments. And I like these when there's a fight on valuation. So you may, as an entrepreneur, say, we're worth $10 million today. The VC says we're worth $8 million today. And you're basing the difference based upon some type of objective milestones, maybe getting a new contract or certain revenue over a certain period of time, where the VCs don't think you're going to get the revenue and you think you're going to get it, or you're not going to get the contract. And so we can basically, through this anti-dilution adjustment, basically say, well, entrepreneur, we're going to give you your valuation, but if you don't hit this mark within whatever period of time that's agreed, we can adjust the conversion ratio to give the valuation that we thought was more appropriate. And so there is a mechanism through anti-dilution that can help an entrepreneur bridge that valuation gap. Because some people think, well, I either have to choose their valuation or lose the deal. And there are some additional techniques through anti-dilution to help bridge that gap that you can utilize. Okay, next slide. Okay, so I'm just going to look at my notes here. So as I mentioned to you, the term sheet covers valuation of those investments. We talked about those rights. The next area of rights that we're going to talk about are management rights in general. And when we talk about management rights, you're going to see rights relating to the board and rights to what we call protective provisions. And as I mentioned up front, you and your investor are going to be partners. Generally, the founders at this stage are going to be majority owners and control the company. And under Delaware law, typically, if you've got a majority of the voting stock, you can elect the entire board of directors. Every director can be elected under Delaware law, generally by the majority. So if you got a majority of the stock, every director can be elected to you. So it's pretty important to investors and to founders to decide who's going to be on the board. Now, I will tell you that, in my experience, 95% of the decisions of the board are consensual. There are very, very few issues that come to the board that have, fights. My experience has been that generally both the entrepreneurs and the investors are working together to achieve the best interest of the company. Now, there may be a difference on that where the founder may think, me founder being CEO is the best interest of the company, and maybe that's not what the investors are thinking. Anyway, so when we look at these boards, and at this early Series A, a fairly typical structure would be two founders on the board, two for the investors, and maybe one independent, a 5-person board. I don't like having huge boards at this stage, 7-person boards, but there may be a reason to do that if there's great domain expertise. I think there's a lot more work on a founder to have a bigger board, because often the founder is going to be spending a lot of time educating the board members of what's going on and managing up, and that's for a different discussion on how to manage a board. One thing to note about this is that there's going to be a voting agreement that's going to cover this. It's not common to give a VC director any equity for their services on the board. They often have provisions in their agreements to prevent that. You should expect, if you're going to have an independent director, that they're going to need to be compensated with equity. And sometimes you see requests for board observers. And I just put a caveat on that is be careful and selective on these. Again, you don't want to have a lot of people in the room. You want to have people to add value. But it is a compromise if you don't want to put another board, another venture person on the board. The board observer is an option. I would note that board observers don't have fiduciary duties, while board members do. And often, if you have a strategic investor, and I work with lots of strategic investors, they are going to not want to be on the board because they have their own issues. Because they have to, have a fiduciary duty to their companies that may have not always the same objectives of the startup. So they'll often take a board observer position. Okay, next slide. Protective provisions are, again, a set of rights that give investors what I call negative control of the company. So remember, the board has the day-to-day control of the company. And if the founders have a majority of the board or have a majority of the common stock, they control the company. There's no decisions going to be made without those decisions. And investors are worried that the founders may make some big decisions that may impact their investment. And so it's fairly common to see what we call negative controls. And these typically are listed in the charter provisions. And these typically are approvals of selling the company, approvals for another venture round. Sometimes they get into more nitty-gritty stuff like incurring new debt. And you would need to really review those with your attorney, what those controls are. I will tell you that in the NVCA forms, there's another agreement called the Investor Rights Agreement, and they have another whole set of more detailed negative controls, which can include firing the CEO or executives, equity compensations. There's a whole number of more detailed negative control lists. And again, making sure you understand what they are. And those are the items that you're going to have to reach and make an agreement with your VC investor partners on those types of decisions. I would note two things to also be aware of. When the decisions are in the name of the board, that board member has a fiduciary duty to the company. And we'll have to act in accordance with that. Shareholders and shareholder votes don't always have fiduciary duties. And so when there's a shareholder vote to approve something, they can look at it, what's in the best interest of my stock? What's the best interest for me as a preferred holder at that shareholder level? And there are differences in deals based upon where you are in the waterfall. Remember, preferred have senior rights, often in a down round situation. So they may prefer certain transactions that common may not, and vice versa. And those do matter, and they can come into play later on. The last thing I would note on this slide is that please pay attention to the percentage of votes required to get to a consent. Generally, an entrepreneur, you're going to want to have lower percentages, like just a majority of the preferred. Often, if I'm representing an investor and I'm putting in 25%, I want to get that percentage to be like a super majority, like 77%. So now I've got a block. So you have to look at the numbers of investors who are coming in and how the syndicate works. If there's just two VCs, you're going to be basically stuck with both of them having to agree. But if you've got three VCs, you want 2 out of the 3 to be able to get consent. And often the seed investors are in the same vote count. So I would really pay attention to that percentage and how it impacts what you have to do to get things done. Okay, next slide. All right, so how do investors get their money out? Here they put in $3 million in my example, and you guys are running the company and you set up your board and things are going really well. In fact, they're going really, really well. And you as the founder are really happy. You don't really want to change a thing. Say it was a private company and you don't want to sell the company and you don't want to go public. Most VC investors are not going to be happy sitting in there forever. They generally have funds that have a 10-year term. So if you came in on year 3 of a fund, year 4, they're looking to get liquidity, well before the end of the 10 years, but, within that 10-year period. So they may have some pressure on themselves to get liquidity to their investors. And so there's a whole set of provisions relating to investors trying to get liquidity. One is called a redemption right. This is typically a right that they say, hey, after 5 years of the investment, I get to get my money back. And there's a number of negotiations on how you calculate what their money's back, but it's generally what's market is they should get back the higher of the fair market value of the shares or the liquidation preference plus usually dividends. Sometimes there's multiple there. And usually they can declare we want a redemption of this right, and then the company may have to get a valuation if it's got the fair market value, and then who does the valuation? Is there a minority discount? There's all these discussions about how you do the valuation and the pricing. And it seems so far away. This is not always highly negotiated, but it can matter a fair amount because you can get up to these points. Other thing I would always try to put in is that, if there is a redemption right, that it's paid over 3 years. Because if you've got a bullet redemption right and it's for 1/3 of the company, it really means you have to sell the company to pay it off. There's something called a registration right. I'm not going to spend really much time on it. It's basically a right to require the company to go public. It's rarely used if management really is doing well and they don't want to go public, it's hard to force them to go public, but it is a right, to say, hey, it's time to go public. We're going to demand registration of our shares, and please register them with the SEC. Next slide. There's something called a co-sale right. This is basically a right for the VCs to include their shares if the founders want to sell their stock and get liquidity. So if the founders, again, founders may want to get liquidity. They've been in for a longer time and they want to get some cash for their money. And if founders find a nice buyer for their shares, if it's a really nice price, the VCs are going to want to, what they say, tag along or co-sell their shares along with it. And that will dilute the number of shares the founders can sell to a buyer. Now, maybe the buyer wants to buy them all, maybe not an issue. We like to limit the co-sell right to just major investors, especially if you get a lot of investors, because it can really be a complicated deal. And sorry for my daughter's noise back there. The converse right is the right of first refusal. So if a founder wants to sell shares to somebody else, the investors usually have a right to either buy those shares from the founder at that price, or with the tag along or co-sell right, sell those shares. The two main things I point out is we got to make sure that we have customary exceptions, like for family planning transfers, estate planning transfers. And we try to, provide for some de minimis exception, like maybe 5% of the shares or, a couple percent each year, can get some liquidity without going through this lengthy process of trying to sell their stock, because it's difficult to find somebody to buy your stock and say, well, maybe you got to buy some other people's stock and maybe you can't because of this co-sell right. We're really running out of time here, so I'll just do the drag along right and then maybe we stop. And ask questions. I can go longer if people want, but a drag along right is a really important right, and entrepreneurs need to really understand what this is. So a well-drafted drag along right. First, what is a drag along right? A drag along right means that whoever signs onto it is required to sell all their stock in an approved sell of the company. Basically, if you don't like the deal, if you signed on to a drag along and whatever requirements to approve that drag along are approved, then you must sell, regardless if it's a bad deal for you. Basically takes away your dissenter's rights and your freedom to make an investment decision. So it's a pretty important right. Now, if the trigger of it is properly, and a most common trigger would be, after 4 or 5 years period of time, if majority of the board, and majority of the common, and majority of the preferred say we want to do a deal, then most likely you're going to be left with just maybe some small shareholders who are looking for some type of green mail, and that drag along right, you guys are totally, the founders and the VCs are totally aligned. However, you may see drag along rights that just say, basically after 5 years, the preferred can find the deal and drag everybody along. And those are the ones that you need to be worried about as an entrepreneur, are basically single triggered drag along rights. We hit 10 o'clock. Do we want to do questions and answers, or do people want me to continue? Amir?
Yeah, if anyone wants to ask any questions, feel free to send in the chat window if you can. We can continue this. We can finish it up. There's no. If anyone wants to drop out, they're welcome to. We'll be posting a link to this please on the YouTube, and we'll be sending a link to all the participants who could not pursue this further after 10 a.m.
Okay. All right. So for the next slide, we're almost done. Other typical investor rights that you'll see in these term sheets. These are often limited to major investors. Now, you may have done a convertible note round or seed or safe round, and there may have been some most favored nations clauses that you have guaranteed investors these rights. So there's often, again, we like to limit these rights to the biggest investors, but you're going to have to expect that if you sign these deals, there's going to be information rights that you're going to have to keep your investors informed. So usually annual audited financials. There may be a delay in the first year audit. We usually want to have the audit delivered, as long as possible after the year, because the cost of an audit that's pretty close to the end of the year is more expensive than in the second half of the year, because auditors are busier with their public company clients. You may have quarterly and monthly unaudited financial statements. And again, delivering monthly financial statements to lots of shareholders is really not ideal. So we try to limit that to major shareholders. I do think generally it's a good idea to keep your shareholders updated on what's going on. Easily an annual newsletter is required, but I actually like my clients who keep their investors more informed. If you're given these quarterly financial statements, maybe a quick quarterly letter. Again, you're busy, it takes time. Investors are going to get what we call inspection rights, which means they have a right to call up the company and ask you questions of what's going on, maybe even talk to your auditors and get more information. You see those rights only exercised when things are going really badly and the company is not providing information. If you basically ignore the company and don't tell them what's going on. So, and there are Delaware statutory rights on inspection anyway, so it's not usually an issue. There's always going to be usually what we call a right to participate, or participation right in future financings, where basically the investors will have a right to keep their pro rata shares available if you're going to do a future round. These are not highly controversial rights. I'm not going to get into pay-to-play rights, but you sometimes see requirements that if they don't participate, that they lose rights and may even get converted to common. Those are not very common provisions, and those are usually put into place in severe down rounds. Next slide. Other typical provisions you'll see in these term sheets are closing conditions. I've highlighted legal opinions. So the closing conditions are going to be basically get all the documents done, that you are going to have, true and correct representations, a lengthy disclosure schedule to the extent that they're not true, good standing certificates with Delaware and California that your company's in good standing. It's pretty rare in a financing, but potentially third-party consent. But one thing that you should look out is a legal opinion. Most investors are going to require you to obtain your counsel's legal opinion relating to not just that all the deal documents are properly prepared and signed and executed, duly authorized and enforceable, but also there's a cap table opinion. And so this is where making sure that before you enter this process, you've worked with whoever your counsel is, that things are in order and there's not going to be any issue for them given their opinion. And, these opinions can take a fair amount of work if you haven't done things right in the past. And so I just note that is something that creates some extra time and cost, and obviously you're going to be paying for it. They'll often say, customer reps and warranties. I just note that the NVC form reps and warranties are thorough. They're extensive. I want you to know that it's going to take, some time for you to review them sentence by sentence, paragraph by paragraph, and prepare a disclosure schedule to those. I mean, sometimes they say list all your contracts, list all your, 83Bs. They can be very extensive. They'll be asking, that all your consultants have signed confidential information assignment agreements. So anybody that's touched your IP signed over the IP to the company. There'll be provisions about any future stock grants having 4-year periods without, consent of the directors. Now, sometimes they don't talk about your employment agreement, but I do think it's an important discussion to have with the entrepreneur, with the venture capital is what is your employment circumstance, and what your salary is, what's your comp going to be, and often this is the last thing that gets done on a deal. And the problem is the entrepreneur, you're not going to hold up a venture deal over your employment agreement. So it's my recommendation is once you got terms and they're very interested in the deal and you're going to start moving forward, what's their expectation on this? Just so you guys know what's going on. Next slide. That's it. I think that's it. So I was able to finish a little more than an hour. I apologize. If there's any questions, feel free to put something in the chat room, or you can email me directly. I think my email is somewhere on, it's right there. And we're happy to assist you guys and look at your term sheets. And I covered a lot pretty quick, so hopefully it was clear.
Perfect. Thank you so much, Larry, for putting these amazing webinars. I love one of these webinars. I mean, so technical, and it's really good for everyone to see, and especially the people who are currently engaged with term sheets or getting ready for it. So getting to know all these terms, it's very important. And thank you so much, Larry, for and thank you everyone for joining us today. We'll be, as I said, we'll be sharing the link if you want to refer back to it. If any of you are entrepreneurs who are looking to raise a round, please check us our website, marlaccelerator.com, where we are recruiting companies for our fall cohort. So we'll get there. Does anyone else has any question? Quick question, anything? Or are you guys all good?
Yep.
I guess
Thank
we're all
you
good.
And we will be bringing these kind of materials and contents almost every week. So stay tuned, and we will publish some of the articles and contents through our website as well as LinkedIn page. So look for us. Connect with us.
Thank you so much. Thank you, Larry.
Thank you.
Guys.
Take
Have a
care.
good day. Bye-bye.